Hi, we're just going to start our last section for Chapter 10, Section 4, and jump from section to section using the table of contents as you need. This part will address interest expense not for the face value bonds, but for the premium and discount bonds. We'll also be looking at redeeming bonds or converting bonds, and we'll be discussing the accounting for long-term notes payable. And then theory-only presentation and analysis of long-term liabilities. And Appendix 10C in the back of the chapter, Appendix 10C, we'll be using the straight line method of amortizing bond discounts and bond premiums. You are not held responsible for learning the effective interest rate, amortization method, just the straight line method. The journal entries for both are the same. It's just a question of how you calculate the numbers. Okay, so amortizing a bond discount. So when we have a bond discount like we did in Part 3 of $7,361, and that, as I said, represents an additional interest expense over the life of the bond. However, companies are not allowed to expense that in the first period of the bond. They have to expense that over the life of the bond. So you'll take that number and divide it by the number of interest payments. So 7,361 in our example divided by 10 interest periods equals $736 semi-annually that the company can recognize as additional interest expense. And that's in the case of a discounted bond. So here they are. It's same facts. We're just getting to the interest entry. So we want to amortize $736. Why can't they amortize it, the whole thing at the beginning of the bond? Because that would be a violation of GAAP. You have to spread that cost over the life of the bond. And that should start to sound somewhat familiar with a fixed asset, where we spread the depreciation over the life of the asset. So here is the bond amortization schedule, and you will need to know how to do this for the exam. So let's look right up here. $92,639 is the book value of the bond on the issue date. The unamortized premium, $7,361. Okay, because it's straight line, look at column C. That's that 7,361 divided by 10. If you had a 4-year bond, you'd divide by 8. If you had a 6-year bond, you'd divide by 12. Okay, so that's what's happening there. The book value at the beginning of the period. Now we're 6 months later. Our first interest payment, our second interest payment, third, fourth, fifth, and so on. So July 1st, the carrying value at the beginning of the period, which would be January 1st, is here. Cash interest to be paid the bondholder. How do we calculate that? On face value, 10% times 100,000 divided by 2. Amount of discount amortization. Add these together and you get $5,736 of interest expense. And we'll do the journal entry in a minute. The unamortized premium goes down in value because we're going to write off $736 each period. Now the value of the bond is starting to go up. So how is this calculated? It's $100,000 minus 6,625. And as this unamortized discount goes down to 0, the book value of the bond approaches and then it reaches face value. Okay, so what's the journal entry for this? As I said, the cash paid to the bondholder does not change whether I issue the bond at face value, discount, or premium. Cash goes out to the bondholders. The 736 is my write-off amount, and the 5736 is the total interest, because that bond cost us more because we didn't get as much money for it. Interest is higher when you sell at discount. Redeeming bonds at maturity. Okay, if this is a straightforward entry. After the last interest payment has been made, all you have to do is reverse the bond payable and pay the bondholder cash. That's a real basic entry, and no matter what the question is on the test, when you get to this question, you should be able to do this. Just take the face value of the bond and cash. Okay, you need to also know how to amortize a bond at premium. The calculations are slightly different. You still divide the premium by the interest payments, and in this case, you still, let's just put that journal entry up. Note the similarities. Cash doesn't change. If you look across your schedule for each of the interest payments at face value, discount, and premium, the thing that does not change is cash is always paid at face value, $5,000. Premium, remember, was a credit balance when we issued the bond, so as we write it off, we debit it. And this has the effect of making the interest payment, the interest expense, smaller. So, bond interest is lower when you sell at premium. And here's the bond amortization schedule. Note that at premium, the book value is higher. Here's the unamortized premium. We divided it by the number of periods and got 811 for each period. That's why it's called straight line. Here's the value January 1st. Here's the $5,000 we pay the bondholder. Doesn't change throughout the life of the bond. And the interest expense, instead of adding these together, we subtract it because we have less that we paid the bond. I'm sorry, I'm getting that mixed up. Start over. The $5,000 is what we pay the bondholder. As we write this off, it reduces the interest expense. And you can see this unamortized premium going down to zero and the carrying value of the bond approaching and reaching face value. Okay. When we get down to redeeming bonds before maturity, we're going to have to eliminate, just like selling a fixed asset before it's fully depreciated, we have to eliminate all these accounts, the bonds payable and whether it's a discount or premium. Then we record the cash paid to the bondholder and we'll book a gain or loss. So, illustrating bond retirements. Let's assume Willis Inc. had sold its bond at premium. At the end of the 8th period, Willis retires those bonds at 103 after paying semi-annual interest. So how do we know the carrying value of this bond on this date? Well, let's go back to that schedule here. After the 8th period, the carrying value of this bond is, what is it? 101,623. And here it is, 101,622. There's some rounding in there, but basically it's the same number. Okay, sorry to flip back and forth. So here we go. We know, and again, bonds payable has a balance as of face value, always does. So we debit that account to clear out that. The unamortized premium amount of 1622. Cash is what we paid for the bond when we redeemed it. We redeemed these bonds at 103. It's 103 of face value. And then if we need a debit to balance, it's a loss on redemption. If we needed a credit to balance, it would be a gain on redemption. Okay. You need to just know this in theory. The book has a journal entry for this, but I'm not holding you responsible for it. If a bond is a convertible bond, it means it can be converted into common stock at the bondholder's decision. So for the issuer, the bonds sell at a higher price. They pay a lower rate of interest than comparable debt securities without the conversion option. Upon conversion, the company transfers the carrying value of the bonds to paid-in capital accounts, and they do not recognize gain or loss. So it's, again, you need that bond amortization schedule to tell you the carrying value. Okay, we're done with bonds. Let's look at our last section, which is long-term notes payable. Long-term notes payable could be secured by a mortgage where you tie an asset to the loan as security. Long-term notes payable typically require the borrower to make installment payments over the life of the loan. So you will see interest on the unpaid balance of the loan and a reduction of the loan principal. Companies initially record mortgage notes payable at face value. So this is like a mortgage. We've seen them in our home loans, and it's a similar transaction. Okay, let's talk about the advantages of bond financing over stock financing with a real example. And remember from our first video lecture that the three advantages are stockholder control, lower tax expenses, and can be higher earnings per share. So I just wanted to illustrate this. And again, this is in your course pack. Let's compare stock versus bond financing. You are the CFO, Chief Financial Officer at Willis Inc. You are forecasting next year's income statement. The company needs to raise $5 million in cash in financing. They have two choices. They can sell $5 million in bonds, which let's just make it simple and say they sell them all at face value. So $1,000 face value, $5,000 in bonds. Or they can sell $5 million in stock. And let's assume an average selling price of stock of $25 a share, or they're going to issue 200,000 shares of common stock. So 200,000 shares times $25 would raise $5 million. Currently, Willis Company has 100,000 shares of common stock outstanding and 0 bonds outstanding. Bonds will be issued at an 8% interest rate. You don't need to know the life of the bond. You're only going to forecast 1 year out. And let's assume a 30% tax rate. So the next slide will show preparing an income statement under each financing method, often called a pro forma. These income statements will be identical up to income before interest and taxes. That word should say interest, not income. Income before interest and taxes. After this point, they will be different. Let's calculate earnings per share under each assumption. And do note that with stock financing, the number of outstanding shares will increase by 200,000. You currently have 100,000 shares, but if you choose the stock financing, you will then have 300,000 shares. Okay, so let's walk through this. Note that these, where it's blue, they're identical. I made up a sales number, cost of goods sold made up, gross margin, less selling, general and administration. Here's income before interest and taxes. And here it is, interest expense. If we choose bond financing, we're going to pay 8%. 8% on what? 8% on 5 million. And it's an annual, so I don't have to, so I would add those 2 semi-annual payments in. Okay. So now we have income before income taxes, and you can see with bond financing it's lower because we had to pay interest. Now we're going to apply a 30% tax rate on the 1.1 million or a 30% tax rate on the 1.5 million, giving us net income with stock financing of $1,050,000, or with bond financing net income will be $770,000. You can see with bond financing net income is lower. There's no question about it. With bond financing, we only have 100,000 shares of common stock. You do not calculate EPS on bonds, you just calculate EPS on common stock. With stock financing, you have 300,000 outstanding shares because you issued 200,000 more shares. Now look at that EPS. What is EPS? It's calculated by taking net income divided by outstanding shares. So that's $3.50 per share if we do stock financing. If we do bond financing, it's $7.70 per share. So what are our advantages? EPS in this example is higher, and you could probably make up an example where they weren't, but in this example it is. You have more control, less shares outstanding, only 100,000 shares, and your tax expense is lower. Here's our tax expense, $330,000 versus $450,000. Okay, that concludes Chapter 10. Goodbye and good luck. I did include additional exercises in the course pack and the solutions follow. This concludes our video lecture.